Thanks, Amanda. Why don't I invite each of our panelists to come take their seats, and then we'll kick it off by allowing each of them to introduce themselves and give a brief background of their company. Mike, okay. We'll let you start.
I'm Mike Rothman, founder and chairman of SMS Assist, and we are a company that is disrupting the property management sector with multi-property across the country. We service about 140,000 both retail locations and residential, using a technology platform to integrate what you would call subcontractors, or we call affiliates, which are about 28,000. So they're on our platform, our affiliates, our operations here in Chicago. We employ close to 800 people now, right, Mark? 800 here, and at the Hancock, and our customers are on it. So it's about big data, collecting it, before SMS. The retailers that you would know would just call the plumber, call the electrician, and waste their time doing that, and no accountability, no visibility. With us, we go directly to customer, and then we pay the contractor. So we've had 50% compounded growth. We're excited, and we're excited about Chicago. So.
Great.
Hey everyone, Adam Hughes, president at Avant. Avant is an online consumer lending platform here in Chicago. We're 4.5 years old. 600 employees based here. And what we do is really two different businesses. The first is we provide online transparent lending products to what we call a near prime or middle class consumer. It's a consumer with an average FICO score of 650, or really a consumer that's been left behind by the banks and has traditionally had to settle for higher interest rates or poor brick and mortar experiences. So we aim to improve that through better data and technology to provide them better products and better experiences. Our second business is a bank partnership model where we've run the last 4.5 years, cutting edge technology. Banks leverage our technology to improve their online customer facing piece, application through fraud prevention, ID, income, and employment. And then they refer customers over to us that don't fit that crime credit box that they're looking to fill. So yeah, that's what we're really excited about and excited to be here.
Great. Hi everyone, I'm Christy Ross, co-CEO and president of Tasty Trade. Tasty Trade's an online financial network where we produce 8 hours of live programming every day talking about the financial markets and teaching people like you and me how to trade in your own account. We have a mission to make finance fun and actionable. We have 40 different shows, and we love what we do. And earlier this year, we launched a new brokerage firm called Tastyworks. So basically everything that we teach and we talk about on air every day at Tasty Trade, you have the ability to use our visual trading technology at Tastyworks and apply all of those concepts. I personally have been in and around the brokerage industry for over 25 years, and I should say brokerage, trading technology, and have been through over 20 mergers and acquisitions and capital raises in my career. So super exciting to be part of the Chicago tech scene, particularly over these last 5 years. So happy to be here today.
Great. Joe.
Hi, I'm Joe McCann, CEO and founder of NodeSource, the Node.js company. Node.js is an open source technology for building software. It's the fastest growing open source project on earth. It's been adopted by 100% of the Fortune 500, and we are the commercial vendor for Node.js. If you're familiar with a company like Red Hat, what they do for Linux, we effectively do that for Node.js. And I'm in the process of actually fundraising my growth round, so this is a very timely topic for me to be covering today. I'm very excited to be here at Techweek.
Great. And just for the audience's information, the iPad here on stage is dead, so I'm not going to get any of your questions that you submit. We'll try to open it up to the floor to take your questions after we get through a little bit more. We'll go back the other direction. So, Joe, you just started alluding to your current fundraising. Perhaps you can talk a little bit about your historical fundraising experiences at NodeSource and any companies in the past, timing, amounts, Anything about the processes that you think would be relevant to an audience, including a bunch of startups who are thinking about how they fund their business?
Sure. So my company is an enterprise software company, but it's built around a technology that is free. So think about that for a second. We compete against something that is literally free. So the story and the narrative that you have to frame when raising money for a company like this is going to be very different than a consumer business, a SaaS business, et cetera. So what I did was I bootstrapped the business out of the first year to kind of see if there was actually a market there. Was there something there that we could actually sell into? Turns out there was. And then I, with no clue what I was doing, started raising money in New York and in San Francisco, and was fortunate enough to raise a $3.4 million seed round a couple years back with an institution out of San Francisco, as well as an early stage fund out of Boston. And through that process, what I learned was, I learned a lot. I learned a lot around the narrative that you need to shape, especially at this certain stage that you are at the business. Moving through seed into Series A, which we closed last year in April of 2016, the focus was really on product and product market fit. And we closed a $12.5 million Series A last April, and we've basically been plowing that money into expanding our sales operation and enhancing our product. The advice I give folks is to really understand your market. There's a podcast or a blog post that Andreessen Horowitz puts out about this sort of problem maze that an entrepreneur has to go through. And what they allude to is that when someone is pitching a VC for funding, the entrepreneur is going to be the person that actually knows the answer to seemingly every potential question because they've thought it through so many different ways and so many different outcomes. And if you don't know the answers to those questions, they will sniff that out. And either they'll use that as leverage in terms of the negotiation for, say, the valuation, or they won't invest in you at all. So I think to really, really understand the problem space is super, super important, irrespective of the stage of growth. Clearly, as you move into things like Series B, metrics and KPIs are super important. But also a lot of growth funds that I've been speaking with they will say to you, we have these certain metrics that you have to sort of meet. And it's actually not true. They will bend and flex based on, say, the market, the team, the product, or the opportunities. So we're excited about the opportunities that we see in front of us, but it is a long haul, so strap in.
Great. Christy.
Okay, so I want to cover a couple things. First of all, prior to Tasty Trade, I was the CFO for Thinkorswim, an online broker, and we ended up selling that to TD Ameritrade back in 2009. But when we were private, we raised money like back in 2004. Now, at that time, Thinkorswim didn't really need money, but one of their biggest competitors at the time, Options Express, had just raised capital. And so sometimes timing matters. Whether you need it or not, that valuation that somebody else sets in the market, we're traders at heart. We're like, okay, that's the time to jump in. Now, fast forwarding to Tasty Trade, so we started Tasty Trade 6 years ago. We actually started with convertible debt. And I personally am not a big fan of convertible debt, but if you're going to do it, you should make sure, I would much prefer to set the price at the time that you're doing the convertible debt versus waiting till later, because there's just too much, there's too much uncertainty and going back and forth regarding valuation later. So that's one thing. We did do a friends and family round earlier on, just because we were actually creating another company as well, and brought in investors, smaller investors at that point. And then we did bring in Technology Crossover Ventures for $25 million in 2014. And the one thing I'll say about that is what we pitched to Technology Crossover Ventures at that point was very different from what we ultimately ended up doing. So the investors were believing in us, in that we will find a way to do something great with this company. We raised money to increase our media exposure. And in reality, we still have done that, but we took the leap to the other side in being a broker, an online broker again, earlier this year. And when we told our investors what we wanted to do, they said, "But you told us when you raised the capital with us that this isn't what you're going to do." And trust me, they're happy today that we've done that. But it's something where when you're raising capital, they're going to believe in you as an entrepreneur. But you're right. You need to know your space backward and forward. And the best time to raise capital is when you don't need it. When you don't need it, when the timing is right, you really need to take all of those factors into account. Probably the last thing that I'll say too is having some, depending upon what series you're raising, showing customer traction is so vitally important, because the number one reason startups fail to begin with is because there's no customer need. If you can actually show a customer need that you're fulfilling, that there's customer adoption, I think that's huge. And then the second reason is you run out of money. So, we truly believe in raising way more than you need. So.
Great.
Okay, great. We're a little bit different because cash is our product. So we've raised a pretty decent size of financing. We've raised over $600 million in equity financing. We've raised over $2 billion in debt financing. We've done 5 rated ABS deals. And that really culminated in a $325 million Series E in October 2015. And I get the question all the time, what enabled Avant in order to do that and partner with the likes of General Atlantic and Tiger Global, Victory Park here in Chicago. And it was a couple of reasons. Number one is our team. 4 of us started the company. We had worked together really since 2006, but we started the company in 2012. So we had 10 plus years of consumer finance experience. But in addition to that, our lieutenants and our lieutenants' just are experts in our product, but also on operations and compliance and legal. And we were able to demonstrate that expertise to these investors that, hey, we're a startup, but we are really complex when you open up the hood as well. Number 2 is just a massive TAM. We've been able to show that, hey, 40% of the US population has a FICO score below 700. This is a massive opportunity, and we know we can do better in terms of providing them better online products. 50% of our customers come in via the mobile phone, making sure that we're leveraging those capabilities that we've been able to build. It's really those 2 opportunities, along with just product market fit. At the time, we had grown to 200,000 customers. Customers loved us. We had 80 plus NPS scores, and really took that Series E money for a couple of reasons. Number 1 is to continue to grow that core personal loan portfolio. We're at 600,000 customers today. And then number 2, really to grow our team. We felt it was really important to be a multi-product shop. We are personal loans today, but we think the credit card space is really screwed up. We think auto is really screwed up. And so in order to execute on those ideas, it's bringing on tech and data scientists to really take advantage of that over the next 24 months. So we're going to be launching a credit card this year, in addition to the bank partnership model I touched on. So really growing that core business along with additional products and partnerships. We decided to take that Series E, but having the team, having the TAM, having that product fit got our investors really comfortable.
Great. Mike.
Well, it's not fair that I go last, because they basically have said everything I would say. But I think to start off, I think that what Christy said as far as one is that, when you raise money, you raise a little bit more than you think you'll have, because when you have that opportunity, you definitely do that. TAM is something that equity brokers, when they sort and look at you, the first thing they look at is, and TAM is, by the way, total addressable market, and they look at how big is your total addressable market. So they're not really interested in a $5 billion total addressable market. So because they're taking a bet, especially in the first or second round on your venture, you want to illustrate to them what your reach is, even though you might have so for instance, SMS, has a very huge TAM, close to 300 billion. But in the beginning, we were a floor service company. which had a narrow TAM. But when I was raising money, I would say, but I'm going to expand to 45 different services. And that TAM looks like 68 billion. Then we got, like you said, when we made Invested, and we made, first round was with the Pritzker Group done in 2011, which just went into the company to help, deleverage the company, which is a $17 million round. And then in 2013, JB tripled down in our company, which turned out to be, a really good bet. But we then pivoted to the single-family rental, which, like if you guys all saw The Big Short, this is people buying those residential homes, and Colony Capital, Blackstone, and that was one of those things, to your point, like you're losing focus, because we were in retail base. We go, no, I'm changing focus because this is density. So we have our business itself is very density driven, like Uber. So a lot of the more contractors, the better we could do, faster we could do. So I think when you're talking to investors, investigate, to your point, do your homework, your total addressable market. And it might not be that today, but say this is what I can be when I grow up. And that I think is important. I also think that a lot of entrepreneurs put a valuation on their company, as you've all heard from venture people, that especially in the first round, that is high. They'll say, this is too pricey. And we all know that equity is precious, right? And you are, entrepreneurs, and I always looked at my equity as very precious. But basically, you kind of don't want to make a home run in your first round, because your second round could be a down round. So you take less at a reasonable thing, because what you should think about when you raise money, and especially when it gets big, our last round was $1 billion from Goldman, okay, is that when Goldman's investing $1 billion, they're expecting a 4x. So you go, okay, so how long is it? Within 4 or 5 years. They say 4 or 5, but they mean 3. Okay, but the thing is, when you do that, a very important thing, and I think the panel will agree, is so to give them a 4x, it's 8x. Because for them to get a 4x, somebody's got to buy them at 4x. So we're at $1 billion, I got to deliver $4 billion. And they got to deliver the $8 billion, right? So when you're talking about valuation, understand there has to be runway for the next person in what you're doing. Does that make sense? You see, so wherever you're going, you have to keep that in perspective, and you got to be able to look your investors in the eyes and say, I can give you a 4x. I have a runway that will get us there. And if we get there, then you're going to have a runway to get liquid. And that could be an IPO, which still will value, how are we going to get more? Or it could be a strategic. So, when we have done 4 rounds, the one other round, we did a 3-round with Insight. And that round, we just put money in our balance sheet. This, I would suggest, is a very important thing to do. So for me, I started this company from scratch. It was like $2 million. I thought my first round was actually at $20 million. Okay, so those people are very, very happy. And my other ones are 10x, so they're happy. And we never in my dreams did I think that it would ever be that kind of round. But when JB actually tripled down in 13, I then start, well, maybe this could be 500. And when you're the entrepreneur who really doesn't have the money, but all the VCs do, one of the things I would suggest is for you, when you really start seeing that this could be something bigger than you ever thought, which you can't think about when you started, you should take in what I call defensive capital, because you can, right? And that's what I did. I took in 45, we were pursued, and we were always pursued, and when you do well, everybody's pursuing you. And I said, and I went to my investors and said, I think there's a value add, which was Insight Partners out of New York, $12 billion fund, and we'd like to take $50 million. Well, we don't need the money. We're making money, we got money. And I said, I just want to put it in our balance sheet gave us leverage to negotiate down the bank, and guess what? Shit happens. And what you want to do is you want to be in a position to have enough money that if something happens, you lose a big customer, whatever, that you have enough money in the bank, because the bank isn't going to help you, so that you can recover for your worst disaster. So you don't have to tell your investor, this is the worst thing that can happen to me, but you know as an entrepreneur. So I did that. Good news is nothing ever happened. It's still in the bank. Good. But if something did, you want to have that money to recover. Okay, if I would have lost, I had a high concentration account. If I would have lost that, I said maybe it'd take me a year and a half to get that back. I can fund my operation without going back to the bank or anything else. So, there's obviously a lot to this stuff, but I think that, you don't want to overpromise, especially in these days, because you never want a down round. So with that, we'll open up.
Great. Thanks very much. So I'll ask one more question for the panel, and then we'll open it up to the audience in a few minutes here. Joe, how do you think about target investors, different types of investors? What's been your thought process around that?
It's a great question, actually. So if you are considering going out and raising capital, don't make the mistakes I did. I'll share a few tips with you that work well for me now. First, based on the type of business that you have, identify the types of VCs and firms that understand your business, period. So we are in enterprise software. There's no reason for me to go talk to a VC that only does consumer. Even if you get a warm introduction, it's a complete waste of time, trust me. The second thing is, once you've identified those firms that understand your business or have made bets in sort of ancillary companies in the past, then you have to find the partner inside the firm that was part of those deals that also understands your business. And if you can get down to that point, you have a greater shot at success in sort of being able to tell your story and convincing them to participate in your fundraising round. Another thing to consider is a strategic investor. So there has been, particularly in Silicon Valley over the past decade, an explosion in what's considered corporate VCs. So Cisco Ventures or Comcast Ventures. It seems like every company nowadays has a VC arm. These folks can be extremely valuable, but they can potentially hurt your business. So let me give you an example. So right now we sell to the Fortune 500. We have customers ranging from MasterCard to PayPal to GoPro to Condé Nast. And if we were to align ourselves with, say, one major technology company like Google or Microsoft, for example, they have a VC arm. The challenge there is that they're typically price insensitive. And what that means is that they have the balance sheet of Microsoft, for example, to invest in your business, which is pretty massive. And they can write a relatively large check size for a small amount of equity. But the then perception can be that you're tethered to that particular strategic. So there are ways of sort of putting together a round where you may have a handful of strategic investors so that you can get access to those particular those corporations. So imagine getting access to Microsoft, Google, and Amazon if you're in my business, for example, without feeling like the perception is actually tethered to any one of them. So these are the things that I think are somewhat less talked about, because you'll see these headlines of these huge rounds with these huge valuations, and as Mike alluded to earlier, that can be a bad thing, right? What you don't tend to see is a lot of the strategic plays coupled with some of these other growth round VCs making the headlines and actually can really prop up your round, especially if you're having difficulty actually raising.
Christy, you want to add anything?
Sure, a couple things. If I can, I just want to add something first to what Michael had said before, just about raising. When you raise more money, definitely having it there for a rainy day or a bad day, but also to allow you to move quickly in an acquisition, being able to have the money in the bank without giving away your liquid gold, which is the equity, and having sort of those extra funds handy. But as far as picking your investors and choosing your investors, Doing your homework, like Joe said, there are some investors that, their fund is not that large, right? Or they write $1 million checks and you're looking for something that's $50 million or whatever. I mean, doing your homework certainly ahead of time, because fundraising, raising capital, literally, it takes 6 months to a year. It just does. You have to start early. And because it's not only is it multiple meetings and presentations, the process of actually doing all the paperwork and the negotiations and all of that, it can really take time. While there are VCs that say we move fast, they do in their decision-making process. But that everything leading up to it, and then actually getting the documents done is there's tails on those sides. So, but choosing your investor, absolutely, you want them to be someone who understands your business, especially if your business is unique or it's a niche business, because teaching the VC about your industry when you have years and decades of experience in it it can feel daunting. Right, and just and a waste of time. So be strategic too. I think strategic partners. Again, on a point he said, we did do a strategic deal, and in some of our business deals, our day-to-day business deals, we had people say to us, "Oh, you're just part of them," and we're like, "No, we're not." So we did have that issue and had to overcome that. And so really sort of our next round, we went out and made sure that it was more of the, more traditional, I'll say. But it's, the last point I'll make is make sure that whoever that partner is, you can work with them. So finding out who's going to be the one that takes that board seat, because people and relationships matter. And someone that you can actually feel like you can pick up the phone and talk to, versus someone just pounding the hammer and picking everything apart. You need it's a relationship. So make sure you like that person, not just their money.
Great, Adam.
Yeah, it's a great point. The only thing I would add is just make sure you have really good legal counsel and really a GC that's an expert in doing these kinds of deals. Of course, you want to do deals with good firms that understand your business and your interests are aligned, but just really be on the lookout for any kind of sharky terms. A down round sucks, but ratchets and weird liquidation preferences and board seats that you weren't aware of, that can hurt even more in some cases. So make sure that you're really on the lookout for a clean term sheet, and as smart as you are, having a lawyer that is really well versed in that area can be very helpful. The second thing would be that's been successful for Avant is just having multiple parties in each round. For us, having names in addition to ones I mentioned before, but J.P. Morgan, August Capital, Peter Thiel have been really instrumental in getting us some really prized board members that have been really helpful on the regulatory side and the operational side, but also as we think about this bank partnership business and really getting us inside to the folks that really matter and make decisions at these banks. So really those two things, just making sure, A, you're protected from a legal perspective, and then just thinking through who that person you're investing, or that is investing in you. Yes, you should have a good relationship, but is there a strategic upside to that partnership as well?
Mike?
Yeah, no, I concur again. I think that, to add on to what Christy said, which is a firm, is the relationship with your board is very important. The communication is very important. When you have bad news, you should share it immediately and make them part of the bad news so that they can be with you, not hide it and then try to do it yourself. That's an entrepreneur trait. So I think that sharing bad news quickly because it aged poorly is something that's important. So that goes to the communication relationship with your board members. And the other thing is, again, legal counsel is absolute. The way your deal is structured is as important is the valuation, basically. The other thing I would say that when you sign a term sheet, you should have the term sheet comprehensive. Like literally do the deal. There's two ways to go. One is a very light term sheet, right? Like I'll give you 50 million for blah, 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 blah. This is the security. And then you end up in the purchase agreement going 4 months for the purchase agreement. You should think of a term sheet as this is the outline to the purchase agreement. So what I have found helpful over the years is take more time up front because you're going to learn hotspots, board seats, covenants, everything in the term sheet. Because then when you have a comprehensive term sheet, not a one-pager, but maybe 6 pagers, you basically are doing all the business. It's kind of like dating or engagement when you're in love, And the other thing about that is when they take that term sheet to their partners, then when something comes up in the purchase agreement, they've got sign-off on a detailed term sheet. It helps. What you have to realize in most cases, and also to talk about the size, right? You want to go, if you're going to raise 50 million, you want to go to a firm that both knows your sector, but that's not a stretch for them. That's right in the center of they're writing $50 million checks, or they're writing $5 million checks. So if you're raising $50 million, you want a $5 billion firm that writes $300 million checks, because then it's $50 million. So, okay, it's easy for them. A lot for you, but that. So bite size, they call it. Because you should also understand that venture firms probably do, and you guys can chime in, 4 to 6 deals a year. Because of the time cycle, they don't have the bandwidth. Most of these firms have 5, 6 partners. So they're not like you think would be doing like, hey, I'm doing 3 deals a month. That doesn't happen. So you pick a firm, you want to be at the low end of their bite size, you want to have a very thought through term sheet. So when they go to their partners, say, I'm doing this deal, can I get your sign off? Then, and you give that term sheet to your lawyer, the beauty is the lawyers can't, okay, we've agreed on all the major terms. So the drafting goes faster. So, and you should always draft, by the way. I would suggest that too. Your console draft.
Great, thanks. I'll try to open it up to questions from the audience. You may need to come down towards the front. Does anyone have a question they'd like to ask? Yeah.
What are the basic table stakes or benchmarks? I know you mentioned about the customers and whatnot before you start to raise money. Speak to maybe traction goals or saying, hey, I want to raise money and I've gotten this, or I've got these revenue spikes or growth. Maybe you guys can all give some good tips regarding, when you're out there, this is going to continue that second meeting or get that conversation going.
So I'll just repeat that a little bit so everyone can hear it. The question was about what kind of metrics are important in lining yourself up for a successful capital raise.
And I'll chime in real quick. And the way that I look at it is, if it's a seed round, really being able to articulate what the need is in the industry. What's that need that you're going to be able to fulfill, and why, right? And be able to articulate that very, very well. When you go to raise your A round, I would say that what you need to have is, this is where you need to show that you really have customer traction, that this is, you have buy-in from customers. They want your product. They want, and you can show that in a lot of different ways, right? And when you move to the next point where you're talking about B, this is truly this growth stage, this accelerated growth where you need more capital to just keep doing great things that you're doing. And when I think you start to look at C, and again, it doesn't apply in this way exactly for everybody, but you're looking at some, exit, acquisition, some sort of, main event. That's the way that I look at it.
Yeah, I was going to say for every business, it's going to be different. I can talk about my business, which is enterprise software. It's typically pretty capital inefficient up front because sales cycles are really long. It takes anywhere from 6 to 18 months to close an enterprise customer, certainly folks in financial services and banking. So I think Early stage, it's the art of storytelling. There is no KPI, there is no metrics at the very beginning. It's here's a huge market, here's a void in the market, we want to go exploit that, or we want to go serve that need. And I think one of the valuable lessons you'll learn in the very earliest stage is the art of storytelling. If you don't have a very solid narrative at the very beginning, you won't even get a chance to get to the KPIs that actually matter. I think on the enterprise software side, it's certainly going to be different than consumer. There's no question that things like customer traction, so how many customers are you selling to? What's the quality of those customers? So for example, I see this a lot in the Valley. Companies will just take customers that are other startups, which means they're getting all their money floating around from various VCs, which the problem then is that if these startups don't stay around and you've effectively gotten all startups as customers, your customers evaporate. Then you have what's called a positive churn rate, which you do not want to have when you go raise money. What you want to have is a net negative churn rate, which means that people are renewing on an annual basis or a monthly basis, depending on your business, and they're sticking with your product or service. And then finally, I think the other pieces that tend to matter the most are how are you evolving the product. If you can actually show that, all right, we're serving the need here for, say, our 1.0 release of the product, and we sold to XYZ customers, but then we juiced the product a little bit more in the second version, and now it's expanded us into different verticals or other customer segments or other lines of business inside current customers. I think it's a key thing to actually point out as well.
Yeah, I mean, the only thing I would add, these guys are spot on, is we were fortunate enough to raise $1 million Series C just purely based on our idea that consumer credit for a near-prime consumer was broken. We were able to raise some early rounds after that because our business was pretty simple. We were able to give out loans at an attractive cost per funded through our affiliate channels, through Google, through direct mail, and did those customers pay us back? And once we were able to do that, the later rounds were really about scale. Were we able to automate all those processes across the product, operations, compliance, and take advantage of not only our one product, but multiple products, then leading into this bank partnership deal. So telling the story, really basic proof points around giving out money, were they paying you back, that got people excited that, hey, our idea seemed to be working. And then the later rounds is really about scale and automation.
Yeah, no, I agree. And I think another thing is that we do, and I think everybody up here is when you set your expectations with your investors, you want to leave enough money in for putting your expenses in front of your revenues a little bit, even though that hits EBITDA or EBIT, depending on what it is. You want to say, I am going to invest my profits into this. Because what you don't want to do is get really successful very fast and then self-inflict. So that's just another lesson learned that we have, not from SMS, but from prior lives. I've been doing this for 40 years. So, but investing in front and not keep worrying about, so that's managing your board and expectations. Say, I'm going to invest whatever your scale is, this much money into, keeping in front of it, whether that's R&D, whether that's people. And that's, I think, one of the most important things I don't think we touched on. Talent is everything. Can't pay too much for it, your people. Also, as an entrepreneur, you want to surround yourself as your company gets bigger and bigger with guys smarter than you and in their field. And that's key, because when investors look at you, especially in rounds 3 and 4 and 5, they're not looking at just you. They're looking at the team. And they want a team because you could get hit by a bus. So effectively, I think all the successful people have put together, like you were talking about, your lieutenants and so forth, and then succession, which we just went through. But you want to get that type of talent, bring in the smartest and brightest. That helps a lot.
Great.
Agree?
About 5 minutes left, so one more quick question from the audience. Anyone? Yeah, do you want to maybe come down or scream loudly?
So if you're like extremely green and don't know anything about what a VC would expect, what do you recommend for people like start understanding the psychology? Like, if you want to talk to someone like that, what they want to get.
So the question is for someone that's very new, has never really raised capital or even engaged with the VC, kind of what are some tips or some things to just get started? One thing that I would recommend is know that VCs are professional deal makers. This is their job. They see 1,000 deals a year. They get paid on pattern recognition. And so if you put yourself in the mindset of a VC, the way that you're going to be communicating to them is going to be very different. They're looking for reasons to not invest in you because they would like to say yes to every deal. So I think if you put yourself in their position as professional deal makers, it will change the way you think about engaging with them. The other thing that I would mention is that with this sort of 1,000 to 2,000 deals a year that they see, how do you actually stand out? And that's, I think, getting back to the point that I made earlier about this storytelling aspect. If you are 1 out of 1,000, potential deals that they're going to see in a year, what is unique about you? What is unique about the story? Because at the various earliest stages, if you've never met with the VC, my advice is to just do whatever it takes to get the next meeting.
And first of all, Joe is spot on in terms of the narrative. You have to have it down cold. So I'm going to give you just one piece of very, very basic advice. Anything you want to get good at, you need to practice. Practice that narrative. Actually put it in front of people who you have no intention of having them invest. Pitch it to other entrepreneurs or investors and let them ask you those hard questions. And you're going to really find out quickly what you're missing. There is sort of I'll call it a structure in putting your decks together, but it really is how you deliver that narrative, how confident you come across, and how passionate you are. If they see that you're oozing passion about this, I'll tell you, there's some weight to that. So it's really collectively all those things together, but practice, practice, practice.
Yeah, I would say get a mentor. Talk to people that have done this before. Come to Avant, we'll grab a coffee. I've done this dog and pony show now a couple hundred times. My pitch from 4 years ago when we started to now is night and day because you need those kind of reps. So definitely talk to me, anyone else on this stage that has done a lot of these deals. We can certainly give you tips behind the scenes, but understanding that process from someone who's gone through it a couple times, I think would be extremely helpful.
Yeah, I mean, coming to things like this is great and networking, but I agree. You just need somebody who's done it. Spend some time with them, and you'll learn a lot. You'll learn a lot. And you have, just to go out straight out. First of all, you're going to need to network anyways. So chances are the person you're talking to could point you in the direction of the VCs that would be interested. So, reach out to the great thing about Chicago here, and with all that goes on here, we have just the Innovation Awards itself has 600 companies, out there. It's just there's an amazing amount of companies that have gone through what we've gone through, and there's also a tremendous amount in Chicago now, VCs. You don't have to be San Francisco and East Coast anymore, especially for seed startup. There's a lot of people. The ecosystem has developed over the years. You could go hang around 1871, that type of thing. There's a lot of people that are interested in seed round, that type of seed round stuff.
Great. I think we're just about out of time. Thanks very much, everyone.
Thank you.
Thank you.